If you want to sleep better at night while your portfolio works for you, in this video I'll show you how the pros manage risk in the stock market. Without stress, guesswork, just investing smartly. My name is Rick, your favorite Italian investor and Manu Ginobili's financial twin. And today, I'd like to talk to you about how not to lose money while still growing your portfolio. You know, like, it's just a dip, it's just a dip. So let's make sure that it's solid ever is. Just a dip. Here's the thing, risk is not the enemy. Unmanaged risk is. So first of all, let me tell you what are the risk mistakes that even smart investors make. And if you believe you make even just one of them, this video is going to be helpful. If instead you don't make any of these mistakes, man, please take my place because YouTube really needs infallible investors. The first mistake that many people make is being overconfident only because their investments are going well. Yes, the classic, my investment in tech went up 20% this year. Let me just go all in on tech and become a millionaire. It's because of overconfidence that most of the time new investors end up going all in on something thinking it will go well forever. But it doesn't. Second mistake, chasing high returns without knowing the downside. Here's the thing. Risk and return are best friends. You can't invite one to the party and expect the others to stay home. So the better a sector or a stock has performed in the past, the higher the risk that it's not going to do so in the future. So understand what you're investing in before investing in it. Third mistake, and this is one of the worst because people make it knowing that it's wrong, is timing the market instead of timing the market. Trying to time the top and the bottom of the market is like trying to catch a falling knife while blindfolded. According to the Dalbar study, which is a study that gets released every year by a Boston-based research firm called Dunbar, the average investor underperforms the market by around 4% annually due to bad timing decisions. For example, over a 30 years period ending in 2021, the average equity fund investor made 7.13% versus 10.67% of the S&P 500. 3% doesn't seem much until you realize that the average investor ends up with 800K at the end of the period, while the S&P 500 would have returned over $2 million in the same time period. Simply put, the reason is that investors tend to buy more when the markets are high and sell or buy less when markets are low. Smart investors instead focus on time in the market, not time in the market. First of all, because if you don't stay invested during crashes, you're most likely going to miss the best days with highest returns. This chart from BlackRock shows the potential loss of return you have when you miss the best days. Based on an investment of $10,000 in the S&P 500 over the last 20 years, if you stayed invested, your 10 grand would have become $71,750. By just missing the 5 best single days in 20 years, you'd end up with only $45,000. And by missing the best 10 days, you'd end up with only $32,000. Less than half then stayed invested, and only by missing the best 10 days. The second reason is that investing for a long time has much more importance than how much you invest. Instead of explaining to you why, I want to show you a video of George Kamel from the Dave Ramsey's team.
So let me show you the power of starting early with investing with this example from Financial Peace University with our friends Jack and Blake. So Jack starts investing at age 21 and invests $2,400 a year for 9 years. Then he stops at 30 years old. So 9 years of investing, total amount contributed $21,600. His friend Blake starts investing at 30, and he invests $2,400 a year till 67. So he invests for 37 years. The total amount he contributes is $91,200. Now they're both at age 67. Jack's investment has grown to over $2.5 million. Blake's investment has grown to almost $1.5 million. So get this, 9 years made a difference of over $1 million. Blake never caught up, even though he invested for a longer period of time. So the earlier that you start, the more time you'll have and the more your money will grow thanks to the power of compound interest.
You see, compound interest is pretty cool. Now, these are the 3 core principles of risk management. Number 1, diversification. Don't put all your eggs in one basket. You've heard this one before, and maybe some of you are saying, again with this diversification. But let's be honest, most people ignore it most of the time. Among ETF investors, the most common case of poor diversification is when you're invested too much into the tech sector. And I know that many of you make this mistake because you tell me the comments. So don't lie to me now And the second common case of poor diversification is when you invest solely in the United States, like if they were the holy grail of investing. By the way, I'm also guilty of this, and my last video was on the downgrade of the US credit rating that happened recently, and I strongly suggest you watch it because I discuss how what's happening has strong, dangerous consequences to the American economy. So diversification is your first line of defense, mixed asset classes, mixed sectors, mixed geographies. If one thing performs poorly, the other will keep you afloat. Second core principle is asset allocation. Know thyself. This one is about you, not about your favorite finance influencer, which is me, right? And not your co-worker who brags about crypto gains. Asset allocation is deciding how much goes into stocks, bonds, cash, or other assets, based on your risk tolerance, your goals, and your timeline. If watching your portfolio drop 20% make you want to cry, maybe you shouldn't be 100% in growth stocks. Pros don't just chase returns. They align their portfolio with their emotions and life situation. And lastly, rebalancing to keep it in check. When one part of your portfolio grows faster than the others, like tech stocks in a bull market, your whole risk profile shifts. Suddenly, you're way more exposed than you intended. So the risk has changed and you need to bring it down. It might sound stupid because what you'd naturally think is, if a sector grows more, why shouldn't I invest more in it instead of less? But the truth is that historically, parts of the markets like growth and value have performed really similarly. So when you see a part of the market perform better, it's often because it's becoming more and more overvalued, and at some point, it has to come down. If you want proof, take a look at the price-earnings ratio of the technology market. We're almost getting to the point of the dot-com bubble crash. When the P/E ratio grows, it means that the price of the stocks is growing faster than the real earnings of the companies, which is not sustainable because in the long term, every market should grow just like the earnings. So how can you manage risk like a pro? Beside the three core principles that I mentioned before, there are three other principles that good investors follow, and they're extremely important for success. Point number one, they are obsessively aware of downside. They are not really focused on how much they could make. Instead, they obsess over how much they could lose. You don't actually need a million good decisions to become rich. But the problem is that since we never consider losing any money, we make so many bad decisions that it's hard to compensate. If we were more focused on not losing money instead of chasing the best returns, we would end up having to make less decisions, but with a greater return overall. Take a look at what Warren Buffett says about investing decisions in this video.
I've told students if when they got out of school, they got a punch card with 20 punches on it, and that's all the investment decisions they got to make in their entire life, they would get very rich because they would think very hard about each one. And you don't need 20 right decisions to get very rich. 4 or 5 will probably do it over time.
Now, point number two, good investors focus on what they know. Buffett is an investor that openly says that there are many investments that he missed because he wasn't informed about them, like Amazon, for example. But he also says that it's okay because it doesn't need to know everything to be successful. Here is the video from Buffett where he mentions the importance of focusing on your circle of competence.
But there's a lot of games I miss. I would have missed Microsoft even if I gotten to know Bill earlier or something. Those just aren't my games. I don't worry about the things that I miss that are outside my circle of competence. I have missed things that are within my circle, and that's a terrible mistake. Those are my biggest mistakes. You haven't seen them. But it's not a mistake because I miss Netscape or something like that at all. I would say that maybe 5% of the companies or 10% of the companies at most are within an area of my circle of competence. There's something I should be able to understand.
And if you don't know what your circle of competence is, or you don't have one, then investing in a broad-based index fund like the total stock market instead of trying to guess the sector that will perform best in the next decade is the best thing to do. So let's get now to the checklist that you need to remember, like the 10 commandments if you want to control your risk in investing. And it's kind of a tongue twister. I call it risk checklist. Number one, know your time horizon. Remember that the longer you invest, the more compound interest is going to push your growth. And mind that the older you are, the more you're vulnerable to inevitable events like big crashes or market depressions. Number two, match risk level to your goals. Remember, it's not all about total return, it's about the total return you want divided by the risk you're ready to take. If an investment has a much higher potential return, but also an extremely high risk, this equation might return even lower than an investment with a lower potential return, but also much safer. Also, ask yourself questions like, can I emotionally handle a 20-30% drop in my portfolio? If you think you can't, then you shouldn't overweight in information technology or growth. Number 3, diversify by asset class and geography. Don't make the mistake of believing that if something happened so far or in the last 10 years, it's going to happen again in the future. Number 4, rebalance at least once a year. You can rebalance by buying and selling, or you can rebalance by tilting your monthly investments toward the portion that perform less as the months pass. This way you avoid having to pay capital gains tax by selling stocks. Number 5, avoid the common pitfalls. Are you resisting the urge to time the market, for example? Are you not overexposed to one hot sector or stock? And number 6, stay process-oriented. Do you have a system and do you already know how will you invest in the next years? Or are you just deciding month after month what you invest in based on what you read or hear on the internet? And lastly, number 7, if you did everything right before this and you invest in broad-based index funds, possibly dollar cost averaging every single month, then you're left with this. Don't watch your portfolio every day. If you've been careful, if you've done everything like this checklist and you also subscribe to my channel, then watching your portfolio would only make you vulnerable to making emotional mistakes. Just keep investing, forget about the value of your portfolio, and check it back after 20 years. I promise you, you won't believe your eyes. I want to conclude the video showing something really interesting that is probably going to cheer you up in case you have any doubt that you can be successful in investing. This is the graph of the rolling 10 years returns of the S&P 500. Rolling 10 years means that whatever year you pick in a graph, the return you see is going to be the average annualized return of the previous 10 years. So for example, if we take 2022, the last year on this graph, the value is around plus 13%. This means that if you invested 10 years before, in 2012, you'd have average plus 13% per year in that decade from 2012 to 2022. Good news is, most of the time, no matter when you invest, within 10 years, you're going to have positive returns. Still, investing only for 10 years, you see that there is some volatility depending on when you start investing. You can get from plus 22% per year to minus 5% per year. If you invest for 20 years in a row instead, things look much better. You can see that there was never a moment where you'd have started investing and have a negative return in 20 years. The worst moment to start would be starting in 1999, right before the dot-com bubble burst. Still, you'd have had an average return of 4 to 5% per year for 20 years. In 30 years instead, the S&P 500 has been truly like a metronome. Predictable, perfect, linear. 10% yearly average before inflation, no matter when you start investing, with a range that is quite narrow from 8% in the worst 30 years to 15% in the best ones. This is one of the cornerstones I have when I think as an investor. 5 years, even 10 years are not a long-term horizon for me. If you decide to invest for the long term, no matter what happens to the market, you're going to come out as a winner. And if you click this button here called subscribe, it's going to be even better because with your help, I can avoid giving up on this channel to be able to make a living out of it. Thank you so much for watching. I wish you a great day or evening. And as always, I'll see you in the next video. Ciao.